Hello, fellow economists. So, today I would like to make a fast walkthrough. How can we process the case study to get the job done and the presentation and the assignments and everything what you require to get the excellent credit. So, first of all, what we need is the Excel. So this case study, sample, solution, equity, FX also, because it contains everything. So you can download it from CoSpace. And then we have also the sample solution, because you can change the numbers and so also sometimes the narratives here. And after that you can submit it, and also you can build up your presentation based on this one. And also at the beginning we need also some data from the case study description, because already you read that one, so this will guide our job. Okay, so in the Excel sheet we have many things here, but first of all we have one really important part, and this is our product description. So what you have to do is that you have to define that, okay, what is your engine for the first stage, second stage, so this should be changed. And of course, if you are changing them, then you have to change the number. So in this case, how many of them do we need for operations? And yeah, so this is the required number for the whole rocket. Obviously, for the second stage, we only need one engine. So this is we need. So that's why if we are using Merlin 1D engine here, then we need 9 of them, and the remaining 1 of the 10 will go to the second stage. You can combine them back and forth if you want. For me it was simple to just use the Vulkan. So number, and of course the number after that will determine the price. So here is the price for each engine. So this is for 2 million euros. So after that we just have to multiply it. So this is obviously 10 for the Vulkan. So that's why we need 3 of them to make it work. So 2 in the first stage, 1 in the second stage. So that's why engine costs will be only 30 million. Also it will define the fuel type. So this is hydrogen. So we need hydrogen. So in this case we just say that, okay, we need hydrogen fuel. Later on, in case of the fuel costs, this is what you can see here: liquid hydrogen, blah blah blah, for such amount of price. Yeah, okay, and then we can see that it will take require 14 tons, so somewhere, yeah, the fuel requirement is here that, okay, we need such amount of tonnage. So this is also coming from the engine, and after that this is the price. That is coming from the fuel. So if we are multiplying them all together, then we get this number here. So practically we have to set this number up, and then we are happy. Next thing is the rocket body. So it can be from carbon composite, or it can be from aluminum lithium alloy. It depends on you. In this case, this one has this cost, and the other one is absolutely more expensive. But obviously probabilities will be a bit different. So let's give it this color. So in this case we don't have to touch this one. These are just representing that 75% of the value will depend on the first stage, and the remaining will coming from the second stage of the vehicle assembly. And then after that, Excel will do the math, and this is what we can recover, this is what we cannot recover. Also fairing, it's automatic thing, so it protects the cargo through the atmosphere. So this is the price, and after that we can still set up our margin. obviously, but we have to balance out the price of the whole launch vehicle, because at the end of the day, this is what matters. So if we are scrolling upwards, yeah. So in figure 2, it shows us that how many launches can we have. So if we are between the different ranges, then we can set up that how many launches do we have. So if until we are under 60, then the gray numbers will be provided to us. If we are between the 60 and 80 million euro range, then we have the orange numbers, and above we have the blue numbers. So obviously we have to set up the margin to maximize our profit, but also to maximize our launch numbers. So that's why we cannot be way too greedy. Then if we set this thing up, then again engine. So probabilities must be defined. So how exploded they are. And that's why we have such probabilities. So this is defined by engine. This is defined by the stage. Yeah, so probability of explosion at launch. So these are the empirical numbers. And in this case, I had to choose this one. So yeah. Then the stage explosion is coming from here. So that's why it's orange. And after that Excel we do the math, so it will takes the difference from 100, then multiplies them, because one component's failure will result the loss of the whole vehicle. Then the first stage landing probability will come from here. So Merlin can already land safely, so that's why it's a proven technology, while the rest will have a learning curve, so that's why again we can see that what is happening here and there. But we don't have to touch this until you are not switching to Merlin 1D. In this case you have to change them. Yeah, then after that Excel we can calculate that probability of first stage reusage, and after that we just have to say that, okay, how many missions do we have? This is coming from here, so this is again coming from the price, so we can say that, okay, setting the price, practically this one is automatic. But after that, this one says that one, and after that, still, we don't have to copy it, it comes immediately. Also, this will come with the probability of stage reusage and the probability of first stage, possibly reusable first stages. So first stages to build will be the difference of the missions and the reused first stages. So with all doing the math, this is automatic, so you don't have to touch it, but you can use it, this table, for further purposes. Okay, so that was all for the production development. Then, obviously, we have to set up the next part of the case study. So obviously, we have to calibrate the profit and loss statement. So you can see that number of sold products in euros, it's coming already from the Excel sheet. We also know that we got the Q per contract, so this is where we can fly 9 times in the 3rd or 4th year. This can be calibrated freely, it's up to you. Just for me it was logical to do it when we can reuse the first stages with the highest probability, so that's why it happens here. Obviously in this case you should not forget that, take the difference. Okay, Next thing, unit price, it is coming from or launch fee, so this is there. Also probability of gaining revenue, so rocket is not exploding, and then revenues both in euros and US dollars, then you don't have to touch it again because this will be calculated. Then expenditure cut due to R&D. We can calculate it, but it doesn't require, so let's keep it 0. And then probability of successful expenditure cut. Again, this is automatically coming from the product sheet, so we don't have to touch it. Unit cost. Unit cost in this case, it means this one. But after that, it's I think it's not used because it's quite useless. Number of produced first key components, so first stages. Yeah, this is coming from the product sheet. Number of produced second key component, this is coming automatically from the number of missions because we cannot recover the second stages and the fairings. And after that, we just have to do the math. I mean, the Excel will do the math, so you don't have to do anything. So, value. So at the end of the day, you can read the cost of sold goods, which is nice. And then automatically it's expected or it calculates the gross profit margin. After that, we have some wages, we have some depreciations. The depreciations will come from the balance sheet. Again, we don't have to touch that as well. We don't want to fire anyone, so we can keep it that way. And after that, we can see that we have EBIT, financial revenues, paid interests, and also hedge expenditures. Wow, right now I have a lot of hedge expenditures. Why do I have it? Because I did not turn it off. Yeah, that's why it's 11111. So obviously, if I don't want to have hedge expenditure, then it will be changing. But of course, in this case, my exchange rates will be turned to this one. So it's up to you. Right now, I don't know since when, but the whole Excel sheet was calculating that I'm following a full hedge strategy. Yeah. Okay. So now we can see that, okay, it's calculating something. It's happy. Also, we don't have to do anything with the parameters, external parameters. So I was showing you how can we build them up and how can we estimate them. But at the end of the day, these are the external parameters. You can use it during the different sensitivity tests. So at the end of the day, what you can see here that what are the losses. And to cover the losses, we can set up the funding need. Right now, this 3 billion euros are with overestimated. So at the end of the day, we just need 40 million euros. So I build a huge safety cushion against going default. But at the end of the day, so you can set this thing up as you want. But also you should not forget that, okay, after that it will determine what happens here, because this money will land in cash reserve and you can burn through it or you can extend it further. But also you have to connect somehow to the debt or to the equity. So one of them should pick this number up. Oh, sorry, not the common equity, so they should be increased. So one of them. Yeah, and after that it will be calculating everything happily. Then we have to turn toward valuation. So of course we have the free cash flow, which is calculated again automatically. So we have the EBIT here, then it will pick the data up from the EBIT row. Then taxes will be also picked up automatically because of the profit and loss statements are already estimated. Then depreciation is already coming from the datasheet. Floating capital is also coming from the datasheet. So this is quite simple. And then we have the weighted average cost of capital to calculate the free cash flows present values. So discount them, and we need a discount rate. So that's why the weight of the shareholders' equity will come from the profit and loss statement, and also the debt will also come from there. So that's why it's crucial that if you need money, somehow you have to determine that what is the source of this funding. And after that, we can set up the expected rate of return from equity. This is coming from the French stock market. So I just downloaded the data since 2003. What was the closing value of the French stock market index? Then I calculated the difference between each years. And after that, I used an exponential return. So practically lambda on the power of time to calculate that, okay, what is the exponential average of this change. So this exponential thingy practically reduces the importance of the past values. So that's why present or close to present changes are much more relevant. And after that, what we can do is to capture the market returns. We are just taking the average of these values. And also we have the risk-free rate. So this is coming from the French stock market. This is coming from somewhere here. So French government bonds, bond yields. Yeah. C36, which is here, but they are also coming from here. So okay, Excel is a bit redundant, but okay, so we can see that. Yeah. And after that, also what we need for CAPM pricing, we need the beta from the industry. This is what we downloaded from the Demoderan database. So if you are opening this Excel sheet, you can find the same beta, but you don't have to do anything because this is also automatic. So that's why, again, if you want to do any of this, then you have to set up that, okay, how much money you need, how do you want it to acquire, through debt or through equity issuance? Because after that, the remaining job will be done by Excel. Then interest rate of the debt comes from C35. C35 interest on debt. This is coming through BBB corporate bond yields, or also you can set up the worst case and best case scenario. So it's whenever you would like to test that, okay, what happens under debt funding, then you can just move this downwards and then it will be assessed this way. Okay. If we did this, then also now the discounted cash flow will be estimated, because the Excel sheet will just pick up the free cash flows, and then with the weighted average cost of capital, interest rate or discount rate, this 3% will be discounting down everything what can be achieved in the future to get this present value. And also still we have some properties, some intangibles, goods, and also cash reserves in the 5th year. Also it calculates the present value of this component as well. So now if we are adding everybody all together, then we have the value. Obviously we still have to take the difference, so we have to remove the debt, obviously, but so these are the present value of the free cash flow. This is the salvage value, but this is the debt, obviously, because we are just focusing on the value of equity. So this is the value of the company in lot of millions. And after that, we can have the different sensitivity test, so worst case debt, best case debt, okay, we can save it and we can be really happy with that, because after that we can create nice sheets about them. Also, we have to think about that, okay, what happens if we are just funding it through debt? So what happens if we are, instead of using debt, sorry, because using debt it's quite simple. I'm increasing, adding this number to this number, so increasing this number here in this cell, and also changing my interest on debt from this number to this number or that number. And after that, valuation will change. Or if I'm focusing on equity financing, which is already here, so we need this amount of money, and then the common equity will be increased. Then after that, I just have to see that, okay, we had 1 million shares, so that was the previous share number. It will be increased by this one. Since I have no idea how to do this precisely, so I just started to increase numbers. So how many things we have to sell until we can see the proper number here, which will be resembling this number there. So if I need less, 6, then it will recalculate that, okay, now we can just collect this amount of money. So oops, that was a bit too much. So this is the share dilution, because obviously I'm increasing the number of shares, the value will drop, and then we can see that, okay, this is the amount of shares what I should purchase at this value to provide the necessary funding for the company. But if we are executing this one well, then obviously the share value will rise, because now it will be recognized what we have done here. So after that we can see that now the added or the changing value, so since we have this amount of shares at this amount of share price, then this will be the product of everything. Yep, and then we have to think about the probability of default. In this case, the probability of default is absolutely automatic. So if you are just checking it, then we just have to say that, okay, this number was calculated. This was the original scenarios. These are the original scenarios numbers. So you just have to pick up this table or figure here. So nothing difficult. Okay, if fixed exposure, then this one can be difficult. So let's go through it. So first of all, we have to identify what kind of revenues do we have in US dollars. That's why the Excel will help you, because we have this whole yellow part here. And in this case, we can see that this is the launch numbers. This is the price in US dollar. You can increase it if you want. We get the contract already, so it's up to you. Okay, under some sensible levels. Then we can see the launch revenues in euros. Okay, so now we can see that this is how much money we can earn in US dollar. If you are using Raptor, Falcon, or so if you are using Merlin, if you are using BA4, if you are using Raptor 2, or even if you are using the Russian engine, you have to pay it. Maybe in the case of Russian engine, you can pay in euros, but the American engines, so this one, and that one, you should pay in US dollars. So that's why it can create expenditures in US dollars. So again, this is engine defined. And also what we can see that after that we have to think about that. Do we prefer depreciation, appreciation? Obviously, because if this is positive or negative number, then we can see that which one is preferred. After that, we can see what was the historical exchange rate, depreciation of the euro against US dollar. We check the forecast. We built up this nice forecast model somewhere in another Excel. So it was also describing some kind of a depreciation. And also when we check the futures market, it also provided depreciation. So then we have to think about that. Is this significant or not? So sensitivity analysis should be made. So let's pick up these numbers. And we already captured it within our Excel sheet. So these are the numbers. And after that, can we see that value was changing at all? So we are going to valuation. We are checking that, okay, what happened with the share price? It was not changing at all. So this is not significant for me. Exposure is not relevant, so I don't have to do any kind of hedging. Still, we can say that yes, but we can do call option fees. So obviously, I can set up a scenario where I'm saying that okay, I can set this up as zeros, as ones. So this will be the total hedge scenario when I'm saying that okay, everybody will have hedging expenditures, and since we are doing it right now, then call option fee for this year. Practically we have only call option year for this year, so this one multiplied by this number multiplied by this number. What is your problem? Okay, until this point is good. Okay, so let's start again. So we have 9 ounces for this fee. Yes. Then we have to multiply it with the exposure or the call option fee here. Okay, I don't know what was the problem, but I solved it. And then we have the launch fee here, multiplied by the number here, then multiplied by the number of there. And now we can see that, okay, this is the price. Does it have an impact on valuation? Yeah, it was decreasing. So that's why we don't want to do any kind of a thing like this. So we can see that, meh. After capturing the numbers, then we can go back to the original exchange rates. This is what we can expect according to our calculations. So these are the option pricing fee, pricing equation. In case of leaseback, you can do it, or you can. It's up to you that if we have property value, then we can sell it, and after that we can mobilize funds. So, but at the end of the day, I just skip this one, so we don't need any of these because these are just raw inputs. So after that, based on this, you can fill up the problem sheet. So what is our problem? And after that, you have to add that, okay, what will be your launch vehicle? Obviously copying this table. Also, we have to define the pricing. and all the, this one is coming from here, this one is coming from here, so obviously you are smart and you can solve it. And after that you can just go through the probabilities. So probability chart is here, that's how exploded this whole thing is and how probable, what is the probability that we can recover any of the first stages. And after that you just have to take the launch number figure defined by the value of your launch rig or launch price. That's what will be determined there. And after that you can just copy and paste everything from the profit and loss statement sheet under the different setups. And also, as we already built in the inflation, so you don't have to do anything with that. So these trajectories are defined by ECB, so we don't have to do anything with that. Just our revenues and costs are increasing according to these curves. So now we are not ignoring inflation at all. And so this is the description for that one, but as you can see it and understand it, then this is not so relevant for us. Also, these are the expenditures from the profit and loss statement. And after that, we can see that, okay, how can we generate profit? Then these are the external conditions. You don't have to touch them because these are external parameters. Then discounted cash flow analysis. Okay, this is, you can maybe delete if you want or not, but okay, this is the whole theory for the whole stuff. So if you are reading it and learning it, it's good for you because you will get smarter. And also after that we can get the valuation. So from here we have to utilize this table. The same structure is present. Also it's fancy to show that, okay, how can we generate much more free cash flows than before. So I think that this guy here already contains this one because I put here the original cash flows, free cash flows. Then cost of capital. Also there is a description that actually how and why we are doing all of this stuff. And after that, how can we get pricing from equity? You can read it, you can change the numbers to your numbers, and after that you can see what happens. And also only funding from debt. This is just the reconstruction, so you don't have to touch it, you don't have to modify it. It will determine that, okay, what is the highest and the lowest interest rate for us. So this is the worst case scenario with the highest possible interest rate, and this is the at least highest possible interest rate from historical perspective, and then this is the lowest also again from historical perspective. And then these are so this is for everyone, you don't have to change it, it's not dependent from the company, this is external feature. But after we tested and compared that what is happening with our funding, again, then we determined that, okay, this is what we need, and this is one way or another way how we can collect them. And also that's why we have to check that if we have interest on that, then if we are not doing anything, then it stays here. If we have to compare the best or worst scenarios, then we have to use it that way and this one or that way. And of course, not just here, but also for all the years. Yes. Okay, so, and again, we don't have to define the share price original because it was defined already. So just you have to produce this number, and that number. So 3 columns. Foreign exchange risk, again, some description that how you should imagine all of these things with option pricing and so on, what you learned at other classes. What matters that if you are using Excel's own beautiful forecasting method, then we get this forecast for depreciation of the euro. If we are using some master or PhD level knowledge, then we can use also vector autoregression model, which is described here. But at the end of the day, we use not even that one, just simple OLS regression, what you learned already on statistics. Just this is fancy one. If I was using it or doing it already, then why not include it here? And of course, this is the sheet what you have to go through. So revenues, expenditures. Again, it can be familiar because I did it here already. So this thing is linked to that one, just with some description. Yeah, these are the forecasted exchange rates. Again, this is external, so you don't have to touch it. You just you should use these numbers. And it is significant, yeah, for me it's not. So no hedge. Then probability of default. Again, there is the theoretical description just to show you that what are we doing and how it was used or not used and so on. So that was the justification for you. What is relevant that, okay, you have to pick up this figure from probability of default sheet. So this guy from here has been copied here, and then obviously our yellow number, which is defined by your current strategy, sorry, or blue number, which is defined by your current strategy, should be under the yellow line, which is defined by the corporate sad reality if we are not doing anything. And after that, obviously we need a conclusion, so where we are defining what happens with the company. So profit increases. People like profit charts, so we can show them that they are really fancy, and what happens with the share value and what is the added value of all these things. And of course, after that, once you did this, then you can also create, I don't know why, but somehow I copied it here. So after that, we can create also our presentation. Okay, so please don't forget group members. Please don't forget to make up your own stupid agenda about what is the vision and mission of the company. So yeah, obviously, since nowadays everybody prefers to be an activist company, so to make the world a better place, even if you are making toast ovens or ice creams or whatever. But we have to define initial problem. We have to define the initial market parameters, so what can we expect? Appreciation, appreciation, increasing interest rates, inflation, still we should talk about them. Then, what matters the most? New product design, why, how, and under what conditions, and how it contributes to higher launch numbers and higher or lower prices. And then profit and value, so how profitability changes, and also how share price can change as well. And then we have to talk about the foreign exchange exposure. Yep, we have to tell this tale, and also we have to say that, okay, at the end of the day, what was the impact on value and profit? This is here, just maybe you can do it nicer. So obviously, nice layout will be welcomed highly. Then this is probability of default, so sensitivity analysis. Yeah, you have to do it. And then we need a nice conclusion. And then you can get excellent mark. Okay, take care, goodbye, and have fun.